Assalamu Alaikum everyone, welcome back to the channel. In today's video we are looking at one of the best dividend paying companies in the stock market. This is a company that I own in my own portfolio. We will be looking at the financials. We're going to look at everything we need to know about this company. Now, in terms of this is my overall portfolio, and you can see I've titled it, passive income. The reason for that is I want to be able to live off some of the dividends, InshaAllah, in the near future. So it might be in 10 years time, in 15 years time, but I am planning to add every single week, every single month, by companies that are undervalued, that hopefully will pay me some sort of a dividend. They don't all need to be just dividend paying companies, but they're obviously I'm trying to grow a growth portfolio as well as the passive income kind of side of things. And InshaAllah, we'll see how it goes. Sooner or later, some of the companies that I'm investing in the growth side might start paying dividends, so you never know. But my overall goal is to actually have some sort of a passive income from these companies. And the company that we're looking at today is one of the biggest dividend paying companies out there, and they have a reliable income. They have an excellent free cash flow. They've been paying dividend over 63 years. They've not paid 63 years. They have paid their dividend consecutively 63 years non-stop. That means when there were, for example, crashes, where there were some sort of a doom in the market, whatever, they've never stopped paying dividend, and they've grown their dividend every single year. So the company that we're interested today is called 3M. 3M is in my portfolio. I have talked about this before, but not in great detail. 3M company is diversified global manufacturing company. It was founded in 1902. They have market cap of $105 billion, as you can see. They have they operate across 4 different business sectors, and these sectors are safety industrials, transportation, electronics, healthcare, and consumer. And each one of these sectors is actually massive and includes loads of different products like this one here. Okay, every single product that you see on this list is basically created a company that's owned by 3M. So when you look at this and you realize how big the company is, I'm sure you own some of these products in your own basically at home, if you just check your what you have. So the company focuses on applying sciences across 12 areas of expertise. They look at design and constructions, manufacturing, commercial solutions, electronics, mining, oil and gas, communications, energy, safety, consumer, healthcare, and transportations. They work with some of the biggest companies out there, whether they are oil companies or transportations, whatever, to actually produce what they use basically for their day-to-day manufacturing of goods that they need to. Now, the company pays a dividend, okay, and this is a safe dividend, and I'll explain that in a second when we get to that stage. But what I want to do first, I want to give you overall the financial side of things, and then we'll talk about the dividend, and then we'll talk about if the company is overvalued or undervalued. Right, so we're going to use simply Save Dividend website, and as you can see, the company the market cap has a market cap of $105 billion. They're not volatile at all, which is quite nice. So when the basically stock markets are going down, is actually not as bad. When it goes up, obviously it doesn't go up either that much as well. In terms of overall dividend growth, they are very slow in terms of the last year or so, but the last 5 years they've actually been average. So they've been growing their dividend about 5%. Last 20 years about 8%, which is not bad. And as you can see, the trend here from 2002 all the way to right now, it's been going up. So there's a time where it just basically was kind of going up a little bit, and then boom, it started moving up from, I think 2012 it's been moving up a lot. And as you can see here, I think it's 63 and not 62, but 62, 63 makes no difference. But they have paid this dividend for 62 or 63 years non-stop, okay, without basically reducing at all. So like I said at the beginning, I do own the stock. So annual payout, this is what I get per share. This is where the ex-dividend, so the ex-dividend is basically the last day you can buy the stock in order to qualify for the dividend. So the pay day will be September 12th. I've already been paid. I think it was about $11 or whatever that I've been paid for the shares that I own. According to this website, there is kind of reasonable, maybe it's reasonable time to buy at the moment. So, and I'll explain that towards the end. When we look at the financials, we're going to look at annually what's going on with the company. So earnings payout ratio is basically the amount of earnings the company uses to pay the dividend. Okay, and I've always said to you guys, 60% or more is basically, anything above 60 is quite high, anything below 60 is perfect, right? As you can see here, 59 is basically where it is at the moment for this company. Free cash flow payout ratio, again, is similar thing. So 60 is basically anything below 60 is perfect, and currently is 48%, which is absolutely fine. Earnings per share is going the right direction. So from 2011, the earnings per share was about almost $6, and right now is about $10. So almost a doubling it there. Free cash flow per share, again, is another free cash flow per share is basically what's left after a company has paid all of its bills and reinvested to maintain the growth of the business, and this is what they use then to pay off the dividends. Okay, and as you can see, if it's 2020, 2021, basically the next 12 months, the last 12 months, sorry, they have got about $12.2 billion. As you can see here, some of the, when it comes to earnings per share growth, the growth of the earnings per share, it hasn't been that great. So it's been kind of fluctuating, but the last, since 2016, 17, 18, it was doing really well. 2019, something, I'm not sure what happened to the company. It wasn't that great. And then obviously 2020, because of COVID, last 12 months is actually rebounded. So it's actually gone up from where we left off in 2018, and then next 12 months it says actually -1, but we'll see what happens. Again, remember, this is just the estimate, so we'll see what happens in the next 12 months. Sales growth, again, is similar thing, so we're looking for about 3 to 7%. Okay, so the sales growth is important driver for earnings growth over time. Okay, so we're looking for about 3 to 7%, and currently is about last 12 months is about 11%. Now, this is really important. The shares outstanding in millions. Okay, so starting from 2011, right now it's declining, and this is absolutely brilliant. This is what you want to see companies doing. They're buying back their own shares, which means the shares that you own right now will be worth more than they were when you bought it. If you had shares in 2011, right now your shares will be a lot more, worth a lot more, because they bought back a lot of the shares, and there's not that many out there. So your shares, actually price shares, basically kind of goes up. And this is what you want to see. A lot of companies will go the other direction and it basically start diluting their shares, and it start giving out more shares, which means then your one share now is almost worth half a share. It's not actually that great. So a lot of the tech companies, newly companies like the Teslas, whatever, they actually do give out a lot more shares every single year. Right, so the next thing is the total sales in billions, as you can see from 2011, and right now it hasn't gone a lot, but it's one of those companies so big they can't actually generate more sales. So what they end up doing is they use the cash to pay as dividend, buy back shares, and then any companies that come in the market that they feel like will add a value, they will purchase those companies as well. So they haven't grown a lot in terms of total sales, but it's still a growth from 2011 to right now where we are. Return on equity is something that we always talk about. 10% or more is what basically most people say. I always say 15% or more, but you can see here we're looking at maybe last 12 months about 47%. Return on invested capital is important. So this is profit by the money both equity and debt holders have given the company to gauge management's capital allocation skills. So they will be, so the money that we give and the money they get from banks or whatever, what do they do with that money? Are they reinvesting? Are they actually using that money in such a way that it will create more profit? And 8%, so above 8% is what we're looking for. Right now it's about 24%, which is really good to see. Again, operating margin, something we always talk about, 12%, but right now it's about double that, so it's perfect, so 24. Free cash flow margins, again, we're looking for about 5%, above 5%, so right now about 18%. So again, really, really good. When it comes to net debt to EBITDA, we're basically looking for, I think it's about 3%, below 3%, but we're now 1.6%. So again, most companies, that's what they're looking for. So again, is next 12 months, but their prediction is actually gonna go up slightly, but is really good position there. Net debt to capital, we're looking for below 0.4. We're looking at right now is 0.53, so it's slightly higher than what we wanted, but again, nevertheless, not that bad whatsoever. Right, so that's kind of giving an overview of some of the financials that we need to look at. Now we're going to go to Yahoo Finance and see what the company, in terms of free cash flow, I'm just going to quickly show you a couple of things. So in terms of growth first, okay, so the next this current year, the expectation is about 15% growth, next year about almost 7%, and then next 5 years almost you're looking about 9%. That's a very good for a company like this, 9% or double digit to actually for this year. That is really good. That's what you want to see. And the other thing that we're going to look at in terms of the price target is, if you look at the average is about 200. Currently the price is 181, lows of 138, and the highs of $219 per share. And this is according to Yahoo Finance, based on these analysts who came together to actually say either it's a buy or hold. A lot of them are going for hold at the moment, and you will notice, you will see that. But I feel like if you own it already, it wouldn't be a bad idea to add to it, and I'll talk about that maybe towards the end. Right, in terms of Yahoo Morningstar, okay, it's actually the fair value is 195, currently is $181 per share. So you can see it's got a little bit, about a few basically points to go up. Now the next thing we're going to look at is the tip ranks as well. So again, it's 200 per share. That's what they're expecting. Currently we said it's $181 per share. So the highs of 225, lows of 172. So again, when you look at this, some of the analysts and what they said to this website, Jefferies, for example, is saying hold, and then these guys are saying hold as well. But JP Morgan is the only one that says has a buy and almost 13% upside, which is not bad at all. Okay, so when if you like I said, if you own it, you might want to keep hold of it for a while and then maybe add to it. Okay, don't sell it, whatever you do. Like I'm not giving you financial advice, but that's what I would have told myself. I'm definitely not selling it. I'm adding to this company, and that's my plan. Right, and as you can see here, my shares, I own about 15 shares of this company. It's worth about $2,500, and as you can see, I would be getting about $88 for owning about 15 shares for every single year. And I'm planning to add a few more. So in the next couple of months, I'm definitely adding to whenever I can, wherever I see. If there's a little dip, I will add more, because my average is quite low. If I buy more straight away, like if I don't dollar cost average, it's gonna go up obviously. So either way it will go up, but I'm gonna see if there's a dip here and there, I will buy more. And the final thing I want to say is overall, generally, in terms of the stock market, September seems to be a volatile month. So this time last year, there was a lot of volatility. Again, is the same thing. And I've heard something, if I'm correct, recently, September's always been the worst month for the markets. And it looks like basically that's the truth at the moment, because it hasn't been great for the last 2 weeks. Again, I'm happy with that, because I've been buying a lot more shares of Union Pacific and companies that actually went down. So you might see a drop in the market, okay, in the next couple of months, and you might actually get an opportunity to buy a bit more of 3M or all the other companies that you like. So just add it to your watch list and keep watching them, see whenever it hits your price target. So if you've got something like this and whenever it hits your price target, then you can buy. You can also do the same thing if you have Trading202 account. You can set price target, and then when it hits that, you get notification and you can buy more of the companies that you need and want, whatever. Right, so that's my overall what I wanted to talk about today. 3M, I do own it, just to kind of show you obviously my own portfolio, because Trading212 today is not, I think the server is down or something, but it's the app works but the website doesn't work, so I can't share that with you. But there you go, I've owned 15 shares. I will get paid about £55 and you've seen what that was in dollars. I think it was about $88 per share, whatever. I'm up slightly, about 4%. It's been up for for a long time. It's been keeping going up, whatever. And when you look at the PE ratio of 17, in fact, there's one other thing actually I want to show you. The PE ratio for this company in comparison to the overall industry is actually quite low. Let me see if I can find it. There you go. So the PE ratio is 18 for the company, and for the industrial sector is actually about 20. So it's actually right now trading cheaper than the overall sector. So that is a very good thing to see. Anyway, I hope you enjoyed the video. Hopefully you've gained something from this. If you like this kind of videos, please let me know. If you have any questions, like, subscribe, and if you have any questions, just as I always said, let me know, and I'll try to answer every single question that you have, inshallah. Assalamu Alaikum. Take care, everybody.